Hello, my fellow investors. In this video, I'll explain in a very great length the pros and cons of cigar butt investments versus growth companies. Now, in the last years, there's been a very strong push towards demonizing cigar butt investments and just saying how good the growth companies are. And I think a lot of these arguments, a lot of these articles I've read, they're missing a lot of context. And they're just putting out one side of the coin. They're not bringing up all the advantages and disadvantages and all these different kinds of strategies. So always in investing, the first thing is the mathematical data. That's financial data, whatever you want to call it. First of all, we need to know the facts. Then we need to try to figure out all the pros and cons, the advantages and disadvantages of everything. Like I remember when I was young, I used to come to my father with a business proposition, and he used to tell me, listen, I would love to buy the Empire State Building, but I don't have enough money. And what he meant by that is that sometimes there's a business which looks very good. Everything on paper is very nice, but there's all different kinds of problems why we can't do it. It could be a realistic problem, a nature, human nature, whatever it is. So the first thing is the data. Then we need to start figuring out all the advantages and disadvantages, what's good and what's bad and everything. So let's get into it. Just remember, if you like this video, so smash the like button and subscribe to the channel, and don't forget to share and turn on the notification bell. So I put in here the data of a 30% grower. That means if I have a company that's growing every year in 30%, and then I put in all the data of a 20% grower and a 10% grower, cigar butts with taxes. I'll show you everything throughout the video. So you should understand what's the number. So over here we have the years. So this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 years, and 20 years, 30 years. You want to figure out all the data for 10, 20, 30 years. So let's say there's a company that's 30% grower. That means each year is growing at 30%. And as a value investor, we always have to look when we're buying a stock as if we're buying an entire company. So in this data over here, we'll have also we could look at it as buying the entire company, and then we could also analyze it as buying a stock and then selling it maybe later on. So if there's a company, the first year it's earning $1,000, the next year it's earning $1,300, and the year afterwards it's $1,690. Each year is growing by 30%. If I'll buy a company at a PE of 30, that means a company was earning $1,000. I bought it at a price earning ratio of 30, which means I bought it for $30,000. I bought it for 30 times its earnings. I just want to show you why people love growth stocks. This is an amazing, amazing, amazing number. If I bought a 30% grow at a price earning ratio of 30, I paid for $30,000. After 30 years, the company is earning $2,015,000. If I own the entire company is one thing, but if let's say I want to sell the stock, and let's say it's trading right now only at a PE of 10, right? So last year's earning was $2 million. It will be trading now at $20,153,000. If I bought the stock at a PE of 30, I made a 671 bagger. That means $30,000 that I invested now turned into $20 million. That's 671 times how much I invested. So I bought a 30% grow at a PE of 30. I sold it at a PE of 10. I still got a 671 bagger. Now let's take a 10% grower. I was earning the first year 1,000, then 1,100, 1,210, 1,331. After 30 years, the company is earning $15,000. If I bought a company at a PE of 1, that means I bought the entire company at 100% discount. I bought not a discount. I bought it exactly at how much it's earning. I'm earning 100% each year. After 30 years, if I sold it at a PE of 30, so it was earning $15,000 a year, and the company is trading. The stock is trading at $475,000. That's a 475 bagger. So that's just to show you how strong it's the compounding. A 30% grower bought at a PE of 30, sold at a PE of 10 is a 670 bagger. A 10% grower bought at a PE of 1, sold at a PE of 30 is only 475 baggers after 30 years. So this is why people love growth stocks. And when you look at it, the numbers, it says, wow, it's amazing. Of course, this is the best kind of investment that could possibly be. So this is the good side. And of course, there's a lot of downsides to all of this. We're going to get into later on. So this is the numbers if you want to look at it. This is a 30% grower. We'll just take everything. The first year is earning $1,000. Everything is calculated in the end. After 30 years, it's earning $2 million. Now, if we own the stock, there's something I want to point out. If I, let's say, bought a company that's growing at a 30% rate each year, it's not that after 30 years, I earned $2,015,000. Then actually what I earned was $8,729,985. Why? Because first year I earned $1 million, the second year I earned $1,300,000, then $1,690,000. If you take all this, is all the money that I earned throughout the 30 years. All this money accumulates together to $8,729,000 after 30 years. This is the total revenue after 30 years is $8 million plus. The total revenue after 20 years is $630,000, and the total revenue after 10 years is $42,000. So if I bought a company that's growing at 30% at a PE of 30, I sold it after 10 years, as is. I earned not selling the company. If I earned after 10 years, I earned 130% after 10 years. After 20 years, I earned, my total revenue was already a 20 bagger. After 30 years, it's already way up. So this number doesn't mean anything. Why? Because a company doesn't just grow alone. For a company to grow, it needs to take all its capital that it's earning and reinvest it in the company. That's the way it works. You take the $1,000 you earned in the first year, you buy with it more assets. You have to invest in your PPE. You have to invest in your SG&A. You have to invest in marketing, advertising. The company doesn't just grow alone. You have to invest the money that you're earning to grow the company. So this number is meaningless. But it isn't meaningless because the difference between buying a company that's growing and you're reinvesting in the company, and that's why it has such amazing growth. In the end, if you own the company, you have the company. So maybe you can look at it as if you earned after 30 years $8 million. But if you own the entire company, you're not earning just $2 million. You have an entire company full of assets and an entire business that's producing now each year $2 million. So if let's say the company would stop growing, you want to retire after 30 years, and you just want to get a fool to take care of the company, and you just doesn't need to do anything, just to keep the way it is, you'll be earning each year $2 million. On the other hand, so let's go down to the cigar butts. If I'm investing in cigar butts, now you probably know what a cigar butt is. It's a famous analogy of Warren Buffett. A guy goes down the street, you find this old disgusting cigar butt, and it still has a few free puffs. So basically what a cigar butt is, you're buying a battered down company that's trading for way lower than its value, and you're waiting to sell it after a few years. So that's a classical meaning of a cigar butt, what people call a cigar butt. But what I want to put inside this category is any kind of company you're buying, and you're not planning to hold on for it forever. It could be arbitrage trade. It could be spinoff. It could be a good company that you're buying and you're not planning to keep it on forever, just to sell after a few years. Any kind of investment that you're buying and planning to hold for a few years and then sell it, we'll just put all this inside the category of a cigar butt. Even so, it's not a classical meaning of a cigar butt. So the 30% growth, the 20% growth, the 10% growth is a company you want to hold on forever. Great companies, you just want to keep holding on forever. A cigar butt is something you're buying, you're planning to sell after a few years after you make you 100, 200, 300%. So if I'm investing in this kind of way and buying and selling stocks, so let's say the great investors say that usually this kind of investment takes in between 3 to 7 years. So let's just do an average of 4% of 4 years, and we're doing a 20% compound annual growth rate. I'll soon get into why I took 20%. But let's say 20% means that each year you're earning, let's say you buy, you invest in a stock. You're selling it after 4 years at 100% gain. So you're earning around 20%, you're compounding it around 20% a year. That's a 72 rule. If I buy a company and I'm earning 7.2% a year, after 10 years, I double my money. If I'm earning 10% a year after 7.2 years, I'm doubling my money. If I'm investing and I'm earning 20% a year, after 3.5 years, a little bit more than 3.5 years, I double my money. So let's say after 4 years, I'm just taking it around 4 years. If I'm earning 20%, compounding at 20%. So let's just take a kind of average. this of course will change from year to year. Let's say an investor, he's a very good intelligent investor, he's compounding at 20% a year, averaging each 4 years he's turning around an investment. So he started off, let's say, with $1,000. The first year he earned $1,200. The next year he earned $1,440. He took the $1,200 and he reinvested it, or it could be that after 4 years he sold his investment for $2,074. Whatever. And then we're compounding at 20%. After 10 years, it's always going to be 20% because he's always compounding at 20%. After 10 years, he earned 6 times his money. After 20 years, it's 38 times his money. After 30 years, it's 237 times his money. And that is before taxes. So someone who's investing at 20% in cigar butts, after 30 years, he made a 237 bagger. Again, if you're buying a 10% grower and he's selling it at a PE of 20, again, this is a 10% grower. A 10% grower. If you bought the company at a PE of 1, at a PE of 5, I'll show you this is amazing number soon. If you bought a 10% grower at a PE of 5, and you sold it after 30 years at a PE of 20, so you earned $317,000, but you invested $5,000. I'll get into a lot of the interesting data soon. But first of all, I want to point out the difference between a cigar butt earning 20% and a growth company earning 30% a year. So a cigar butt at 20% after 30 years, it's $237,000. A 30% grow after 30 years is $2 million. That's amazing. That's just a difference of 10%. So, what I want to point out over here is that, getting back to the first issue that I went to, is in a cigar, but your whole time you're holding cash, and you're just reinvesting the cash over and over and over again. You buy a company, you sold it. You buy it, you sold it. You buy it, you sold it. In a grower, in a 30% grower, you're just buying the stock and you're holding it on forever, or for 10, for 20, for 30 years, whatever it is. So I'm coming back to the first point that I started about a 30% grower and the total revenue. So it's not that after 30 years I earned $2 million. After 30 years I earned $8 million. But these $8 million were reinvested in the company, and that's how the company continued on to grow. So I can't look at it as if I have $8 million, because that money is gone. It's reinvested. Just like I can't look at a cigar, but I can't accumulate all the money earned. In the end, the last number that I'm holding, that's the real number that I have. I don't care how much money I earned throughout the years. But in a company, if I bought a company and it's growing at 30%, all this money that was redeployed into the company, although this cash is gone, but there's a company. And if I sell this company now, which is earning $2 million, if I sell it only for a PE of 10, I'm selling it for $20 million. On the other hand, in a cigar butt, what I have is my cash. That's all I have. I have after 30 years, that's all I have. I have $237,000 and $376. That's what I have. I don't have any business going on. If I stop right now, that's nothing. I don't have anything besides this cash. In a company, the way you have to look at yourself when you in value investing, when you're buying a company, is that you're not just buying a stock price. You're buying a part of a company, and that company is redeploying its cash. It's continuing on to grow and grow and grow. So this is an amazing thing that buying a company has over a cigar bond investment. So that's what I wanted to point out about the total revenues in a company. So the total revenue was actually $8 million, but it was reinvested. If I stop after 30 years, I have a company that's generating me each year $2 million, even if it's totally stopping its growth. In a cigar butt, if you stop, that's what you have. So you could take the $300,000 and invest it in a bond or something, or in a good company, and get your dividends or whatever it is. But that's what you have. Now, just to prove the point of the difference between buying a company that's continuing to grow in a cigar butt. So over here we have the company that I bought as a 30% grower, and after 30 years it's $2.15 million. Now, if I do the same exact business in a cigar butt that's earning not 20% a year, but it's earning 30% a year. So here we have a cigar butt earning 30% a year. So the first year I invested $1,000, on the first year I earned 30%, $1,300, and so on. After 30 years, it's $2.6 million. So it's the same exact like the first one, which is after 29 years. But and in the company, I just put in the numbers. I invested it, and then I earned the first year. I earned what I earned. The next year, it grew on 30%. I couldn't take in the growth of 30% on the first year. So in the cigar butt, the first year I invested $1,000. I earned $1,300. After 29 years, it's the same like after 30 years over there, or whatever. It's the same thing. The number is the same exact number. But in a cigar butt, if I'm investing like this, that's what I have. After 30 years, I have $2 million or 2.6, whatever it is. That's the money I have. That's it. If I stop working, that's all I have. But in a growth company, I have the same exact amount of money after 30 years, is $2.50 million, but I have an entire company that's been growing the whole time. And if I sell the company at a PE of 10 even, that's $20 million. That's 10 times more than if I would have been doing cigar butts. And if I'm selling at a PE of 30, that's $60 million. That's 30 times more than the cigar butt investment. So that just to show you the difference between when you own a company and when you're buying a stock, you're looking at yourself as your part in the company. You don't own the entire company, but you own the part of the company. It's much more than what you're earning. It's also the company's worth is growing the whole time. And a cigar butt, you're just reinvesting the money over and over again. But when you stop working, that's it. That's all you have. So this is a huge advantage of owning a growing company than just reinvesting your money in cigar butts over and over. Okay, now I want to show you something interesting. If we take this 30% grower in a span of 30 years, usually, statistically speaking, like every 7 years is a recession, more or less. And I'm going to show you something. It's also if you own the company and also if you buy the stock. Let's say once every 7 years is a recession. And in 1 year, in that time, the company didn't grow 30%, it didn't have any growth. What would happen? So let's just look at the number over here. If someone who owns a company is selling the company after 30 years at a P of 30, it's $60 million. 1 year, there was no growth. It went down $50 million. Now let's say again, after 7 years, same thing. There was no growth. Another $10 million went down. If it happened 3 times in a span of 30 years, that's $27 million. So, same exact company in a span of 30 years, and only 3 times in 30 years, there wasn't any growth. After 30 years, if the person who owns the company decides he wants to sell it, or if a stock owner is selling it, and it's still the same exact thing at a price-earning ratio of 30, it's half of the amount he was going to get if there was every single year 30% growth. So this $27 million, and look at it after the taxes, it's $17 million. That's what he's going to get. I'm just going to go backwards. 35 and $23 million after taxes. Going back again, 45 and $60 million and 39. It's exactly half. Before taxes, it went down from $60 million to $27 million. After taxes of 35, it went down from 39 to $17 million. So I'm just saying, even an amazing growth company, no one can fight a recession. And it could be 1 year with no growth. It could also be that there was a span of 5 years where they had only 5 or 10% growth. And a lot of other things. This is just showing out the math. What happens if there was just a few years in that span of time which the growth wasn't so amazing? Now, I want to point out something very, very interesting. And maybe people who learn mathematics know this, but maybe there's a lot of investors who never realize this. Let me ask you a simple question. If I buy a company that's growing at 10%, and I buy it at a PE of 5, so that means the company is earning $1,000 a year in this particular case. I bought it at $5,000. So each year I'm earning 20%, right? If I'm buying a company at a PE of 5, I'm earning each year 20%. Besides the 20% I'm earning each year, I'm also getting a growth of 10%. So the first year I earned the 20%, and the next year I earned the 20% plus 10% growth. So we'll take a 10% grower and compare it to a 20% cigar butt with a compound annual growth rate of 20%. After 30 years, when I have a 10% grower bought at a PE of 5, I earned only 300%. Right? I bought it at $5,000. I'm earning each year 20% plus 10% growth. After 30 years, I have only $50,000. How could it be that buying at a PE of 5 plus 10% growth, after 30 years, I have only $15,000, and in a cigar butt investment, which I'm also earning only the 20%, but not earning the growth, after 30 years, I have $237,000. How could it be? So the answer is very simple. if you look at a company and you say, wow, this company's growing with 10% and I'm buying it at a PE of 5, you have to understand something very simple. When you're buying at a PE of 5, you're not earning 10% each year besides the 20% of your PE. I earned the first year $1,000 on my $5,000 investment. On my $5,000 investment, that's 20%. The next year, I earned the same 20% on my initial investment plus a 10% growth. But I'm not earning another 10% on another 20% on my $1,000 investment. Same the third year, I'm earning my 20% on the $5,000. That's $1,000 plus the 10% growth is another $210. But I'm not earning another 20% on my year before. So when you're buying a company at a PE of 5, you're not compounding at a 20% rate. It's just you're getting each year 20% on your initial investment, but it's not continuing to grow. Your growth is going to come only as a 10% growth. But when you do a cigar butt investment and each year you're earning 20%, you're compounding at 20%. When I invested $1,000, the next year I earned $1,200. The next year I took that $1,200, invested at 20%. I earned $1,440. I earned 20% on the $1,200. And the next year I earned 20% on my $1,440 and so on. But in the 10% grow bought at a PE of 5, you're not compounding at 20%. You're just getting the same 20% over and over again on your initial investment. And you're only compounding at a 10% growth. And this is amazing. Even if you bought at a PE of 5 and you're growing at 10% each year, after 30 years, you only made 3 times your initial investment. If you took $5,000, after 30 years, you have $15,000 a year. In a cigar butt, which you're doing 20%, after 30 years, you have $237,000. That's amazing. But again, if I have a 10% grower, I'm earning each year $15,000. I could retire, and I'm still earning every year $15,000 besides any other growth. And again, if I'm selling the company, let's say I bought a stock, that's a 10% grower at a PE of 5. After 30 years, it's earning $15,000, and it's, let's say, trading at a PE of 20, then I could sell my investment for $317,000. So again, that's where we see the difference between owning a stock and between selling the stock. If I did a cigar butt, after 30 years, I have $237,000. That's all I have. And 10% grower, if I bought it at a PE of 5, although I earned only 3 times my initial investment, I'm earning that each year now. But if I sell the company, all the money was reinvested in the company, grew, has more assets, and it's a bigger company. If I sell it at a PE of 10, then I'm earning only $158,000. It's still less than $237,000 of the cigar butt. But if I'm selling at a PE of 20, then it's $317,000. That's more. Okay, now I want to show you another interesting thing. If I take this 30% grower, and what I put in over here is bought, the BNS, bought and sold at PE of 20, and this is bought at PE of 10, sold at PE of 20. So I'll just explain to you all these numbers. If I bought a 30% grower at a PE of 10 and sold it at a PE of 10, or if I bought it at a PE of 20 and I sold it at a PE of 20, or 30 and 30, that means I didn't lose anything on the buy and the sell. It's just the growth of the company. It'll be the same exact numbers. It doesn't make a difference if it's a PE of 10, 20, or 30. If it's the same exact buy and sell, so this will be the numbers. After 30 years, my compound annual growth rate would be 28.87%. So if I bought the company at a PE of 20, I bought it at $20,000. After 30 years, I earned $2.2 million, $15,000. My compound annual growth rate after 30 years would be 28%. After 20 years, it will be 28.31%. And after 10 years, it will be 26.63%. So if I bought and sold at the same exact PE, the more the time goes on, the more I'm earning. Right? After 10 years, it was 26%. After 20 years, 28%. After 30 years, 28.87%. It will never, ever, ever go beyond 30%. If I bought and sold at the same exact PE, you can never grow more than the 30%. It will never pass the 30% growth. Now, if I bought, so over here we saw bought and sold at the same PE, it will be the more time goes on, the higher my compounding would be, but it will never pass the 30%. Now, if I bought at a PE of 10 and I sold it in a PE of 20, so besides my 30% growth, I'm also earning on that I bought it for cheap and sold it for more expensive. I bought it at a lower PE and sold it at a higher PE. And over here, it's exactly the opposite. After 10 years, so I bought it at a PE of 10, so I bought it at $10,000. After 10 years, I earned $10,000. I'm compounding, I sold it at a PE of 20, so I'm compounding at a 35%. After right? I invested $10,000 at a PE of 10. After 10 years, I sold it at a PE of 20. I sold it for $2 million. After 10 years, I sold it for $106,000 and $44. I'm compounding at 35.72%. After 20 years, I bought it at PE of 10 and I sold it at PE of 20. I'm compounding at 32.83%. I sold it after 20 years at a PE of 20 for $2.92 million. After 30 years, I'm compounding at 31.88%. So the more time is going on, I'm compounding at a lower growth, at a lower rate. And why is that? The reason for that is, in the end, eventually, you can never earn more than the company is growing. And growing doesn't only mean by the EPS. What the company is growing, in the end, you can earn more than the company is growing. If you buy a company that's growing at 30%, you'll never be able to earn more than 30%. So if you bought it at a lower PE and sold it at a higher PE, so you have additional earnings, additional revenue that you bought it for cheap and sold it for expensive. But per the company, you can never earn more than the company is growing. And the same exact thing would be at a 20% grower. If I bought and sold it at the same exact PE, after 30 years at 90%, the lower I go, the lower I'm compounding. If I bought it at a lower PE and sold it at a higher PE, it's the opposite. It's the lower, after 10 years, it's 26%, after 20 years, it's 23%, and the same exact thing would be with a 10% grower. If I bought and sold it at the same exact PE, the less years is I'm compounding at a lower rate. If I bought it at a cheap PE and sold it at a higher PE, it's exactly the opposite. And that's what I said. And eventually, you can never earn more than the company is growing. And I just want to show you a clip of Warren Buffett. And I also left in the end the Charlie Munger remark, just for the great humor. And he explains this. It doesn't exactly explain this issue, but that's exactly what he's saying. So you could watch this video.
We're quite a bit less enthused about those stocks as being any kind of obvious bargains than the people that you read about in OID. The returns on equity in most areas of Japanese business, returns on equity are very, very low, and it's extremely difficult to get rich by being the owner of a business that earns a low return on equity. We always look at what a business does in terms of what it earns on capital. We want to be in good businesses. What we really want to be is in businesses that are going to be good businesses and better businesses 10 years from now. And we want to buy them at a reasonable price. But many years ago, we gave up what I've labeled the cigar butt approach to investing, which is where you try and find a really kind of pathetic company, but it sells so cheap that you think there's one good free puff left in it. We used to pick up a lot of soggy cigar butts, I had a portfolio full of them. And there were free puffs in them. I made money out of that. But A, it doesn't work with big money anyway, and B, we don't find many cigar butts around that we would be attracted to. But those are the companies that had low returns on equity. And if you have a business that's earning 5 or 6% on equity, and you hold it for a long time, you are not going to do well in investing, even if you buy it cheap to start with. Time is the enemy of the poor business, and it's the friend of the great business. If you have a business that's earning 20 or 25% on equity, and it does that for a long time, time is your friend. But time is your enemy if you have your money in a low return business, and you may be lucky enough to pick the exact moment when it gets taken over by someone else, but we like to think when we buy a stock we're going to own it for a very long time, and therefore we have to stay away from businesses that have low returns on equity. Charlie?
Yeah, it's not that much fun to buy a business where you really hope this sucker liquidates before it goes broke.
Okay, so we all heard what Warren Buffett has to say about cigar butts and about return on equity. In the end, you're not going to get a lot of money from a cheap company. So I brought this video because also he's speaking about cigar butts, and he's speaking about a company with low return on equity. And I'll conclude the first part of this segment on analyzing the mathematical data. Is we just now saw the why a big company, a growth company, is so good, and I'm going to bring it I'm going to bring afterwards another video of Warren Buffett about cigar butts, which is not, he speaks about cigar butts a little bit differently than when he speaks over here. But over here, it's exactly what I wanted to show you in this video. a company that's earning a low return on equity, it's not a big grower. In the end, you'll not earn more than the company is earning. Even if you buy it at a very cheap price, if you hold it for 30 years, in the end, you're going to be earning at the same amount of money that the company is returning. A high growth company, you're going to be earning a lot of money, but you can never earn more than the company is growing. If it's a small grower, if it's a slow grower, if it's a big grower, it'll always be the same exact thing. Buying at a low PE and selling at a high PE, you'll just add on another revenue of buying at a cheap and selling it for more expensive. If you take that amount of revenue, divide it to 30 years, it wouldn't amount up to a big amount of money. So now we have to get on to the next part to start figuring out all the advantages and disadvantages of cigar butts. And there's a lot of things to figure out and analyze, and it could change from person to person. There's a lot of things to figure out over here. And I think this part is the most important part that investors have to understand. The data is very nice and good. On paper, everything is nice and good, but there's a lot of things you have to figure out. Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much. Okay, so let's start analyzing and figuring out all the different. So I put that all out in the categories, and I'll go by one. So cigar butt cons. The number one is taxes. So if I buy a company and I'm just holding it for 10, 20, 30 years, I'm not paying taxes. As for now, you don't pay taxes for unrealized gains. As long as you didn't sell it, doesn't make a difference how much money you're earning, you're not paying taxes. As long as you didn't sell it, it's unrealized gains, you're not paying any capital taxes. But in a cigar butt, when you whole time investing and reinvesting, every time you sell the company, you're paying taxes for it. So I'll show you the numbers, how it works out. I took here the cigar butts at 20% CAGR before taxes. And then I did the same thing with 15% tax and 20% tax. So why did I do this amount of tax? So usually a cigar butt will take, like investors say, between 3 to 7 years. So if you got a good investment and it took you over a year, it's a long-term gain. So it depends on how much income you have. It will be in between, right now, it's in between 15 to 20%. So we took over here the cigar butts after 20 years, and you came up with $237,000. If I'm paying 50% tax each time I'm selling it, that this same amount would end up in $111,000. That's taking over 50%. Now this is an exact number because it depends very much how much times you bought and sold. I just what I did was I took the same exact calculation, but I took over 50%. So I did it only 17% growth each year instead of 20%. So you're taking over 50% taxes. And if you're paying 20% tax, if you have high income and you're paying 20% taxes, so this $237,000, when you're paying 20% tax, goes down to $85,000. That's you just now knocked off 2/3 of the income. So the taxes is a big consideration. But the first thing is, if you do your investments in IRA, you're not going to be paying taxes. Again, that could change. It's a lot of variables, and that's one option. The second option is if you're not very rich and you don't have a high income, then sometimes you won't be paying taxes even in a cigar butt. So it depends very much. But one thing is for sure: if you're buying a growth stock and you're not selling it, you're not paying any taxes, no matter how much money you're earning, no matter where your investment is, in a normal bank account or in an IRA, whatever it is, you're not paying taxes. In a cigar bond investment, where you're buying and selling the whole time, so if you're not doing it in an IRA, and so you have to take in the consideration of the taxes, and I'll just show you the same exact investment without taxes, $237,000 after 30 years, and with 20% taxes, that's $85,000. That's a huge amount of money. But another thing I want to point out is that also in a cigar butt, in a huge grower, a 30% grower, yeah. So if I sold the company after 30 years, and I sold it, let's say, at a PE of 30, which is $60 million, and I paid 35% tax, and you're going to pay taxes. If you're selling anything for $60 million, you're going to pay taxes, and you'll be paying a lot of taxes. Doesn't matter how much income you have. If you're selling a stock for $60 million, you're going to pay a lot of taxes. Let's say 35% taxes, this $60 million turns into $39 million. And if you sold it at a PE of 10 for $20 million, you have $30 million. So we can't just look at taxes in a cigar butt versus a buy and hold for 30 years, because eventually you're going to be paying taxes over here also. So that's one thing. Taxes is a huge consideration. It definitely changes the entire strategy. It depends how much income you have, where you're investing in. That's something you have to consider. Now, another thing is big money. like you saw in the video from Warren Buffett, he says you can't invest in cigar butts if you have a lot of money. Once you get to huge amounts of money, you can't buy a cigar butt that's liquidity is $1 million, $2 million, $3 million, $10 million, and you can't invest in it $100 million in such a kind of a company. And if you're managing huge amounts of money, you have to start looking at the growth stocks. So I think that Warren Buffett, in his first version, before he turned into what he is today, he did only cigar butts, like you saw in the video that I showed before. I'm not sure he would have ever changed into what he is today, if not that the reality made him do it. He came to realization, I can't find cigar butts at such huge amounts of money. I have to start looking for long-term buys. So that's another whole thing that we need to get into afterwards. It's about the circle of competence and of growth stocks. Okay, the third issue is constant work. Now this is another big issue. If you buy and hold a company, you're not doing anything. You could just read the reports once a quarter. If you check out if you have any problems. If not, you continue to hold it. In the cigar butt, your whole time you're buying. Your whole time you have to search for companies. You have to invest, sell, reinvest, sell, reinvest. You're working the whole time. It's more of a business than an investment because you're working the whole time. In the buy and hold, you could just buy it and not do anything for 30 years. So it will be a huge consideration. Someone who's working and he's a part-time investor, it will be much harder for him to invest in cigar butts than in just a buy and hold. He could, let's say, decide he wants to buy and hold, look for amazing companies, doing them research for month upon month, and once he comes to consideration that he thinks it's a great buy, okay, he could buy it and just hold it on forever. Cigar butts is you have to work much more. So that's another a disadvantage of cigar butts. And number 4, retirement. Like I pointed out before, when I'm holding a huge grower, and it's not only if I own this company and it stops all its growth, I decide I want to retire, I'm just taking any fool who could just keep the company running as is. I'll be earning huge amounts of money every year, but without the company growing. And if I sell the stock also, I'm earning a lot of money. In a cigar butt, if you're working the whole time, if you want to retire, whatever you got till that day, that's all you have, nothing more. You're not gaining any more money. So that's another disadvantage for cigar butts. It's a constant work, and if you want to retire, whatever you have, that's what you have. And another thing, a disadvantage, is hard to find in the bull market. So good growers, good companies are popping up, that not the whole time, but if you find a very good company and you're willing to pay for even a big price, there's always times you can find these companies. These companies are very rare, but they're there the whole time. But in a cigar butt, if you're going into a long bull market, especially in the end of the bull market, it'll be very, very hard to find cigar butts. So sometimes it could be a long time we don't have anything to buy. And I'll show you a clip of Walter Schloss. He worked at Benjamin Graham. He was a pupil of Benjamin Graham. He's a great friend of Warren Buffett. He is the cigar butt investor. He was always a cigar butt investor. He never changed till the end of his life. He had an amazing career. In 45 years, they say that his CAGR was 20% before fees. He took 25% fee for himself as a management. But he had a great, great career. And I just want to show you a clip, what he says about the bull market. That it's hard to find stocks in the bull market.
And all I know is that my son turned to me one day and said, "Dad, I can't find any cheap stocks." And I said, "At my age, let's go out of business." And I just knew that the market was going to bubble because the high-tech stocks were acting very crazily.
Okay, so let's get on to the next part, is the cigar butt pros. What's the advantages of cigar butts versus growth stocks? So the first one is cigar butts always work. And what I mean by that is there's a human nature. And human nature is when they find something on sale, they want to buy it. And I'll give you an example. When someone tells you a sale, what's in your mind? Buying something for cheap. You go into a store, there's a product selling at a sale, 20%, 30%, 50% off. A human nature is when they find something cheap, they want to buy it. That's just human nature. You would never, ever, ever, ever see a company doing such a kind of a sale. They're going to sell you a product 3 times the price of what it costs. And they're telling you like this: you're buying this pair of shoes for $300 instead of $100, but in 10 years, you could give it to us back after wearing it as much as you want. We'll pay you back for $1,000. No one is going to buy it. The company will never do such a sale because all the rich people buy all the shoes and earn a ton of money. But someone would see such a thing, he wouldn't buy it. He'll say, no, but maybe I'll forget it to give it back in 10 years. People don't like to buy things for more than their price. But when they see something for cheap, human nature is they want to buy it. So what I mean to say is, people are saying the cigar butts don't work today like they worked once. Things changed. The markets became more efficient. Yeah, it could be. But the cigar butt approach will always work. Growth stocks were relying on the market and the human factor that they will be willing to pay a huge amounts of money at price earning ratios of very high amounts. I mean, we don't know if that's going to be. Now, if I own the company, then of course a big row is much better than a cigar butt. But when I'm buying a stock and I'm relying on it that in 20, 30 years, the price earning ratio would be 10, 15, 20, 30, we have no idea that's going to happen. So I'm not saying that a growth stock is less of an investment because of that. I'm saying cigar butts will always work. Growth stocks, we don't know. There's so many factors that could change that could make it a less how would I say it, unknown factor or reliable. You can use different kinds of words, but cigar butt would never change. It will always be a good investment. Okay, number 2, less research, and this is a huge factor. When you want to buy a cigar butt and you want to make sure you're not losing money, so you can basically go with this. I'm looking for a company that doesn't have a lot of debt and the management is a good management. You'll find a lot of good companies. In growth stocks, you have to do so much research on the company to be sure that there's no risk factor. And it doesn't make a difference how good you know the company. There's so many risk factors that you don't know. Let's say you're buying into a company that has huge growth because it has a new technology. Maybe there is already a risk that you don't know that exists already. A new technology is coming up that's going to kick out the old technology. And maybe it is a risk factor that doesn't exist yet, but it's going to happen in 5 years or in 10 years and will take this company totally out of business. So not only do you need to do a lot of research on the company to be sure that the growth could continue and that the company will continue to be efficient and a lot of other things. There's so many things that you don't know about. And it's much harder to do real good research on a company and to be sure that you know you're buying a good company. But in cigar butts, you need to do much less research. Okay, number 3, more strategies. And what I mean by this is like this. A growth company, so there's only one thing. You're looking to buy a great company for a good price, a reasonable price. That's all there is in growth stocks investments. In cigar butts, there's a few options. Or you could specialize in cigar butts. That means you learn how cigar butts work, and you could become a specialist in certain kind of industries, or you could be just a specialist that buys a lot of different kind of companies, a lot of different kind of industries. But you learn not to buy companies with bad management, companies with a lot of debt, and so that could be one strategy. Another strategy could be a totally different kind of strategy. So there's a famous value investor by the name of Joel Greenblatt, and I'm just going to show you something that he specialized in. I'm just going to read you this from Wikipedia, and I'll just read it out for you. In 1985, Greenblatt started the hedge fund Gotham Capital. At Gotham Capital, between 1985 and 1994, Greenblatt presided over an annualized return of 50% after all expenses, but before general partners' incentive allocation fees, or 30% net of all fees. Gotham specialized in special situations like spinoffs and other corporate restructurings. So he wrote an entire book about spinoffs, and so this wouldn't be the classical cigar butt of a bad company, but this is, as I said in the beginning, in cigar butts, I'm saying all kinds of companies that you're buying, not to buy and hold, but to buy and sell in a few years. So Joel Greenblatt, he specialized in spinoffs and corporate restructurings, and he made in a span of 9 years 50%. That's amazing amount of returns. And so he specialized in a certain kind of cigar butt. So that's another kind of option that you could do in cigar butts. In growth stocks, there's only one thing, to find amazing companies and invest in buy and hold. Cigar butts, you have much more options. And I want to finish this off in another strategy. And this is a video of Bruce Greenwald, and he will bring up a totally different strategy. I never did research on what he's saying, but it absolutely amazed me when I heard what he says. If he's saying he's probably right. I don't know. I never researched it, but this is another option that could be used in cigar butts.
The stocks you want to look at if you're not going to be a specialist are stocks that are obscure. So ideally, you're the only one looking at them. Small companies in faraway places. But most important, look really bad. They are undesirable. Where you as an investor look at that opportunity, whether it's because this is a time where everybody thinks things are falling apart, or this is an industry that's in real trouble, or this is a company that's in real trouble, and you look at that and you say, oh, I'm not investing in that. And when you see that, that's actually where the opportunities are. It is obscure, ugly, sometimes other supply and demand imbalances, but cheap stocks that you want to do. Portfolios simply that consist of the 10% of cheapest stocks on any stock exchange in any extended period in the United States and in almost every country but Italy, and it's reassuring that it doesn't work in Italy, outperform the overall market, depending on how often you trade those portfolios and so on, by between 3 and 6%. And you can do it just by statistically applying that test, calculating a ratio of market value for the company to its book value, and picking the lowest market to book ratios. And that will do phenomenally, not every year, but over time, that will do phenomenally. Now, it's interesting what those portfolios look like. 2/3 of those stocks go bankrupt. But the ones that don't do so well that those portfolios significantly outperform the market.
I really recommend to watch the entire lecture of Bruce Greenwald. He speaks a lot about the problems in growth companies. I'll put the link in the description. It's an amazing lecture. A lot of things I learned from him. But getting back to our point. So, as I pointed out, there's more strategies in cigar butts. So I said there's one option is to specialize. You could just become specialized in picking certain kind of cigar butts. Or you could be like Joel Greenblatt, who specialized in spinoffs. Or you could just do Bruce Greenwald's strategy, just buying all the cheapest companies in the entire market. And another option is to be more diversified. So I want to show you a clip of Walter Schloss and how much stocks they usually own.
We didn't lose money very often, and that's why I kind of wiped it out of my mind. We didn't sometimes buy a lot of stock because I was a little nervous about putting too much money in a stock, so we never put too much money. I owned over 100 stocks most of the time, and that way we had a big diversification.
Okay, so let's get on to the next part, a bigger circle of competence. I think this is the most important issue about cigar butts advantages versus growth companies' disadvantages. Now, everyone knows what circle of competence means. So, for whoever doesn't know what it is, basically what it means, you have to stay in your circle of competence. Don't invest in things you don't understand. If you can't evaluate the risk, if you don't understand the company, if you don't understand the industry, you can't evaluate the risk. If you can't evaluate the risk, stay away from it. That's something everyone understands. If you don't understand the tech, don't invest in tech because you don't know what's your risk. So this kind of circle of competence, everyone understands. What I think a lot of young value investors don't understand is the circle of competence doesn't only go into kind of companies that you don't understand and kind of industries you don't understand, not to buy them. It's also your investment strategy. So Joel Greenblatt, his circle of competence is buying spin-offs and companies restructures. Okay, great. Someone who doesn't understand how these things work, it would be out of their circle of competence, to buy these kind of securities. They just don't know how to evaluate all these different kind of risks. So don't invest in a kind of an investment strategy that you don't understand the risks. So the same thing goes about cigar butts versus growth stocks. And what I mean to say is like this: it's not so hard, it's not very complicated to analyze the past. The past, we know what's going on, we know what happened, so it's pretty easy to analyze it. It's much harder to analyze the current events. Are you sure you know exactly what's going on? Maybe there's things you don't know that's going on, and it's much, much, much harder and almost impossible to analyze the future. You could maybe have a good educated guess, but you can't really know. So, what I mean to say is like this. To buying cigar butts, you're analyzing the past. You're saying, okay, I know what the company did in the past 10, 20, 30 years. I know how much money they were earning. Why did they get into this complicated situation? I know how much debt they have. I know how much money they're paying for the debt. Whatever. When I'm buying a growth stock, I have to analyze the future. I mean, I also have to analyze what happened in the past. What's the current events? To evaluate if there's any risks that I know or I don't know about. And besides that, I have to analyze the future. People who think that they could start investing and after 2, 3, 4, 5 years, they already came to a position where they know how to analyze the future, they don't understand that this kind of analysis is out of their circle of competence. I don't think Buffett would have ever been in his situation today if not he would have been such a successful investor for so many years in cigar butts. He grew his circle of competence. In the beginning, his circle of competence was only buying cigar butts. And then he grew his circle of competence into starting to analyze great companies at great prices, then great companies at so-so prices. It's not easy to become a great analyst starting at the hardest part of analysis. I think a lot of people don't understand this. Yeah, growth stocks is much better than cigar butts. The question is, are you capable of analyzing a growth stock in the same way you're capable of analyzing a cigar butt? And I want to show you a clip of Seth Klarman. And if you after what I just now said, I think you'll understand his words totally different. And another thing I want to point out before I show you this clip is, if you disagree with someone, if you want to know if you're right, first try to understand what's his point of view. If you understand what's his point of view and why you think he's wrong, then there's a better chance you'll be right. If you're not even thinking about his point of view, then it will be harder for you to get to the truth. Let's try to get into the head of great investors like Benjamin Graham and Walter Schloss and Seth Klarman and all these kind of different investors who made great amounts of money throughout their careers. Why don't they feel good in investing in growth stocks? Why are they sticking to cigar butts? Try to understand them, and then maybe you'll understand what's the hard part of analyzing growth stocks. The way I see it is they feel it's out of their circle of confidence. They don't feel confident in investing in growth stocks because they say, this is easier for me to analyze the past. To start trying to guess what's going to be in the future is much harder for me. And if you understand why that's how they feel, then you'll understand what's the hard part of analyzing a growth stock. So here, let me play you a clip of Seth Klarman.
But are you different than Warren in terms of how Warren has evolved and how you have evolved? Obviously, I think Charlie Munger had some influence on Warren in understanding to not just to look for the classic example, the cigarette butts, but to look at things that were reasonably priced with the belief that they could be, that there still was a margin of safety.
First of all, a lot of my Charlie Mungers are out here in the audience,
yes.
So a lot of people here that I bounce ideas off of, and we share thoughts.
How have you evolved? Is my
Warren
question.
evolved from.
Is it different from Warren?
Warren evolved through 3 stages. He went from buying cigar butts and getting the last few puffs
Right.
for free, to buying great businesses at really cheap prices, to buying and holding great businesses at so-so prices,
Right.
and maybe even this new area of buying weird securities from crappy businesses at better than market prices,
Right.
like B of A
Right.
preferred or whatever. I'm still in phase 1. We're still buying cigar butts. There's a good business there in buying them, and it's a lot of fun.
And that's what you're proud of.
No, I feel like I have stunted growth, Charlie.
Okay, and just to point out, like, who is Seth Klarman? So I'm reading this from Wikipedia, and he closely followed the investment philosophy of Benjamin Graham, and is known for buying unpopular assets while they were undervalued, seeking a margin of safety, and profiting from sales from any rise in price. Since his fund's $27 million inception in 1982, he has realized 20% compounded return on investment. He manages $27 billion in assets. So I don't know until when this number is from 1982, if it's still today, 2022, so that's 40 years. But even if it's went on for 20, 30 years, compounding at 20% is amazing. And like all these people are bashing all these cigar butt investors, like, who outperformed them? I just want to say, give me a list of 10 great investors who outperformed for 30, 40 years these great investors like Seth Klarman, Walter Schloss, who also compounded for 20% in an amazing career of 45 years. Even take Peter Lynch. Peter Lynch had compounded at 29% in a time span of 13 years when he managed the Magellan Fund. In 13 years is not a lot of time to compound in growth stocks. So maybe he wasn't doing the classical cigar butts, but I'm saying again, when I'm speaking about cigar butts, I'm speaking about buying a company and planning on selling it, not on holding it on forever. That's not what Peter Lynch was. Peter Lynch was buying and selling, like the first version of Warren Buffett. You have Peter Lynch compounding at 29%, Seth Klarman at 20%, Walter Schloss at 20%. Give me someone on the other side. Nick Sleep. Nick Sleep is like known for being the growth stock kind of investor. How much did he compound in his 9 years that he managed his fund? Okay, so let's just take a quick look who is Nick Sleep, and I'll give us some perspective. So this is an article in Yahoo Finance. The Nomad Investment Partnership was an investment firm managed by Nick Sleep between 2001 and 2013. So we have a 12-year period. During this period, the firm achieved one of the best investment track records of any hedge fund. Wow. So what's the best record? One of the best records. In its final letter to investors, the firm highlighted a 20.8 per annum return before fees between September 2001 and December 2013. 20.8 in a span of 12 years. That's one of the best. What about Peter Lynch, who had almost 30%? And Seth Klarman, who had 20% for 30, 40 years, and Walter Schloss, who had also 20% for 30, 40 years. To do it in a short period of time of 12 years isn't so amazing. And like also while you're looking at 2001, 2013, that's great years when there's a very, very, very strong bull market. But let's just continue on. What did he do? On a net basis, the fund returned 18.4% compared to an annualized return of 6.5%. Okay, whatever. According to the record video from Manish Pabrai, who's a close friend of Nick Sleep, Nomad was forced to close its doors, whatever. In a recent question and answer session, Pabrai explained that when the partnership closed its doors, Sleep had 40% of his firm's assets invested in Amazon. The remainder was split between Costco and Berkshire Hathaway. So basically, this fund had 40% of the entire assets was invested in Amazon, and the rest of the 60% was invested in two companies, Costco and Berkshire Hathaway. So this is the most you could get out of a growth company, a growth investor. You're buying Amazon, Costco, and Berkshire. And how much did he do in this span of 12 years? 20%. He didn't beat any of the great cigar butt investors. So what I'm pointing out is, give me a list of 10 great growth investors who invest only in growth, and we can see that they beat the cigar butt investors by huge amounts. Maybe there is. I don't know. I never heard of them. So I'm just pointing out as another thing. On paper, everything looks very good, but it's not so easy at all to become a great growth value investor. It's not easy. And young people who think, okay, look how amazing this is, think twice. Maybe this kind of investment strategy is out of your circle of competence. That's all I'm trying to say. It's not as easy as you think it is. There's a lot of risk factors that you don't know, and that you don't even understand how to evaluate them. So I think this is one of the most important things young value investors need to know. Growth companies are amazing, but it's much, much harder to analyze them, and you have to be a much more experienced investor to learn how to invest right in such kind of investments. Okay, so let's get on to the next point. And cash is king. This is another advantage of cigar butts versus growth stocks that you're buying and holding. And now, cash is king is a famous saying in investment terms. That a company with a lot of cash is a great company. But over here, I'm referring this to totally different meaning. When you buy and hold a company for 20, 30 years, if you're not getting dividends, so basically all your money is unrealized gains. You're not gaining anything from it. If you're very rich and you don't need the income, so okay. But if you need the income, you're not getting anything from it. But in a cigar butt investment strategy, if you don't have enough money, or if you want more money, then you can always take out from the investment without hurting the strategy. So you want to buy a car, you want to, I don't know, do anything else. You want to buy a new house. You could take out part of the money and use it for whatever you need in life. But in a growth stock, if you're starting to buying and selling whenever you need the money, so you need the whole strategy. The whole point is to buy and hold it forever. You can't just decide, okay, now I'm selling, and then I'll buy it again. So over here, I mean, cash is king from not as an investment strategy, but as a life strategy. People need cash in their life. If they're not filthy rich, they don't need the money. Okay, but if you're an investor and you need the money, so you need cash. Sometimes you need to take out of the investments for yourself. And this could also go on to another things, which a lot of people today forget, that in the past 70 years we've been living in very peaceful times, and sometimes times are difficult. There's wars, and throughout history, sometimes there's difficult times. If you have cash, it's good. If your money's stuck in somewhere and you can't sell it, I mean, there was times, there were years in history with the entire market was closed down. So imagine someone bought a stock, and it's okay. The company is doing great. He can't sell his stock because the market is closed. Imagine if now he needs the money, he can't take it out. So cash is king. People need cash in their life. So that's another huge advantage to cigar butt investment when you're buying and selling, and the whole time you have cash, versus buying and holding forever for decades in a growth company. And I want to play a clip of on this point from Walter Schloss. I think also that's the point I'm trying to say.
I was always struck by the fact that the Rockefellers, who were really really intelligent and smart people, I don't think they bought any shares of Berkshire Hathaway. Now, you'd think that they would, because they didn't need all the income, but it just shows that Warren is a very brilliant guy. But the problem is that if you wanted income, you didn't get any from him. All you got is a capital gain. But if you needed income, and you have to wait 20 years to cash in on it, so that growth stocks are good for wealthy people. I think that's true, but I like the idea of being able to sell your stock. Now, people who...
Okay, so let's get on to the next point. The disadvantages of growth stocks. So point number one, it's harder to do future analysis. So basically this thing is going back to the pros of cigar butts about the circle of competence. It's much harder to do future analysis. And so this is basically the disadvantage of a growth stock, which is the same the advantage of the cigar butt. So this is, I already explained this in length. So the next point is buying early or late. And this is another very, very important issue. If let's say you found a company which has amazing growth, and the industry is growth, or the company is growth, whatever it is, you can't buy the company too early. And what I mean too early is you can't buy a company based on its growth before you see that this growth is actually has turned into revenue, into profits. There are companies who have amazing growth, and they never were able to turn into profits, and they're losing money. And let me give you an example. Is Twitter. Twitter was a company before Elon Musk bought it. Was a company which basically was in the entire world. It's an amazing growth. Twitter, throughout its history, never earned a penny. They never had any retained earnings from the beginning of their inception until the last day they were a public company. In the entire lifespan of a public company, They lost every single year besides 3 years where Trump was the president and Twitter was blowing up because of Trump's tweeting the whole day. Besides those 3 years, Twitter lost every single year. They lost money. Now, Twitter has its own problem. Their management was crazy. Today we all know it, but anyone who looked, I looked only one time at a 10K of Twitter, and I knew right away I'm not touching this company. You just saw the way they were managed. It was amazing. They didn't care about earning money. They were giving out huge amounts of compensation to their executives. It was managed very, very, very badly. And there's a very famous value investor who, I'm not going to say his name, who bought Twitter back in 2020, and he sold it eventually. And when I heard that he bought Twitter, I was shocked. I said, how could such a person call himself a value investor and buy a company that never earned a penny? Till today, I don't understand it. And this just shows the point about people who are so fixated on growth. Because it's so hard to find good growth companies, so they start looking into companies that have amazing growth, but as a company, they're not yet profitable, or they're not efficient, or they have a lot of other obstacles that they have to come through before they turn into an amazing investment, besides being an amazing growth company. So if you buy the company too early, you're in a problem. You're taking a huge risk. Maybe the company wouldn't be able to capitalize their amazing growth into profits. And you can also hear Peter Lynch saying this about Walmart. He says, if we would have bought Walmart in the first year, it would have been amazing. But even if you would have waited 5 years, you still would have made an amazing investment. And then you just would have taken out the risk factor that maybe Walmart wouldn't be able to fill its potential. So this is a big disadvantage. You can't buy too early. And another thing is you can't buy too late. So what I mean to say is a growth stock, you basically have a window. This window could be 10, 20, 30, 40, 50 years, whatever it is, that you could buy this company. If you buy too early, you may be taking a huge risk that you don't know. This company with growth will never turn into profits, or maybe just be bad profits. And the other side of it is a growth company can't grow forever. You can't. It's just impossible. You can't compound forever. Let's take a company like Apple. Eventually, Apple will stop its growth. Apple, in the end, will come to a position, even if every single person on the planet will have an Apple product, that's it. That's where the growth will end. They'll come to a position, if they don't find another planet with more people who want to buy Apple products, the only way they could grow is by people starting to buy their products more often. You can't grow forever. And I'll just give you another example. There's no company in the world today that exists today that's 500 years old. And eventually all companies will die. That's a fact. It's not a statistic, it's a fact. There's no company that will last forever. Eventually it will die out. If it will be for war, if it will be whatever reason it will be. So in buying a cigar butt, you're taking a certain a time frame, saying, okay, I think this company would go from one place to another place in the next few years. I'm going to earn 10, 15, 20, 30% in annual rate. In a growth company, when you're looking at to buy at a very expensive price, and looking at 10, 20, 30, 40 years, you have a very small window where you could actually earn a lot of money. You can't buy too early, and it's not going to be forever a growth stock. So this is a huge disadvantage for growth stocks, that you can't buy too early, and it's not going to last forever. And just to close off this whole part, I want to play you another clip of Walter Schloss on Xerox, and then this will be an amazing to close this whole issue.
I kind of like companies that manufacture goods, basically. I think if you ask me, do you buy an airline stock? No, I haven't, but I don't know enough about the airlines. And, the airlines is an area where it's had fabulous growth, but the stockholders never did very well with it. So getting a growth stock is not always helpful if you can't, if it doesn't come out so that you can make some money out of it.
I'd like to know, would you rather buy outstanding companies at fair prices or fair companies at outstanding prices?
That's a good question. And I don't think I'd like to buy good companies at what I think they're worth. I really I have no problem buying a good company, but I wanted it at a discount. I'm looking to make a profit, and I don't want to lose money. And if you can, at times, once in a while, people get very nervous, and you can buy a good company at a fair price. I don't really like, I can't generalize because each company is different. But if you want to make a profit, you really want to buy a stock at a price that you think it'll go up, say 50%. Now, it may take several years for that stock to go up, and then you just have to be patient. Now, one day, this goes back to about 1951, you weren't around and so forth, but the fellow came to me and he said, you know, there's a company that we're interested in that one of the, I can't even remember the name of it. It was a company that analyzed other companies, and he said this particular company said that there's a method there where they can copying machines, and the Battelle Institute in New York, I think it's in New York State, has said this company has great possibilities. Stock was selling, it was selling at about 20, and it had gone through the Depression. It was listed on the exchange. It was a small company. And I went into Mr. Graham and I said, you know, this company's got a new product, you know, a copying machine. And he said, well, you know, Walter, we don't really buy stocks like that. Well, of course, it was Xerox, and it went up a great deal. And the only consolation I had was that it had gone from 20, where we saw it, had gone to 50, they would have been out of it. And the fact that it went up to 1,000 to 2,000 after splits, I wouldn't have bought it. I bought it only because historically there seemed to be an interesting stock. But he was right that it really, you didn't know that this particular product was going to be such a success. The only thing you could say was the Battelle Institute said that it was good.
Okay, so let's finish this off as a historic look what happened to Xerox. And I brought this clip of Walter Schloss. I could have brought a lot of clips of all kinds of green investors on growth stocks and all different kinds of things. There's no point in comparing because you can't just say, okay, that's what happened to that company, that's going to happen to this company. And that happened then, this is going to happen now. No. Each company, each time needs to be analyzed by itself. I brought this clip because he's speaking precisely about his problem with growth stocks versus cigar butts. And I just want to bring out Xerox as to finish up everything. So he's speaking about what happened in 1950. Now, I don't know what over here, but here we have the Xerox stock. And he said it went up to $2,000 after splits. But if we go here, in 1962, so it's trading at $4. 1962, we're going to go here to 1972, $73. Well, let's just, I don't know exactly what happened in between. Let's just say from $4 to $80. Or even from $4 to $72 in a span of 10 years. That's an 18-bagger. It's amazing. It's amazing. It absolutely is amazing. And what happened afterwards? It just crashed on. And then what happened afterwards, basically for years and years and years and years, I had a problem. And then, it went up again. Okay, Xerox has a long history. You can check it up. I'm not going to get into it. So, again, basically from 1990, $14, it went all the way up to $140. Again, that's amazing again. And then it crashed back down. And where is it today? At $15. So, what I'm bringing out in Xerox is, if you bought it too early, you didn't know your risk. And if you bought it too late, then again, so the window was closed already, all kind of competitors came inside. There was HP and all of other things. So this is like a example of a growth stock. If you went in too early, you didn't know your risk. You went in too late, then you're going to lose a lot of money. And so that's what I want to finish this part about buying early and late. The third part is hard to find. So that's already basically, it's the same thing over again. You want to find good stocks. It's very hard. Cigar butts, there's plenty of cigar butts. And to find good growth stocks, it's in your circle of competence. And you're not buying it too early and you're not buying it too late. And you know how to analyze them. It's pretty hard to find. You can take Nick Sleep, who's like the investor who's called a growth stock, who invests only growth stocks. What did he have in his portfolio? 3 stocks. That's all he found. 3 stocks. And even those amazing 3 stocks in 13 years, he did 20%. He didn't do anything better than cigar butts investors. So let's get on to the advantages of growth stocks. So only the company. If you own an entire company and not just buying a stock and selling it, it's amazing. Like I said, you don't need to work, you don't need to worry about anything, and you're not paying taxes. As long as it's unrealized gains, you're not paying taxes. And if you want to sell it then at a high PE, so it's amazing. It's basically going all the disadvantages we had about the cigar butts, that you have to work the whole time, and if you want to be tired, that's all you have. So in growth stock, you have everything just the opposite. If you want to retire, you just continue to earn money. And I wanna put here a clip of Warren Buffett on cigar butts versus growth stocks. Another clip, not the one I showed at the beginning, and it will give us another perspective. So let me play it for you.
In the years from my reading, in the years from 1956 through 69, you achieved the best results of your career quantitatively, 29% annually against only 7% for the Dow. Your approach then was different than now. You looked for lots of undervalued stocks with less attention to competitive advantage or favorable economics and sold them rather quickly. As your capital base grew, you switched your approach to buying undervalued excellent companies with favorable long-term economics. My question is, if you were investing a small sum today, which approach would you use?
Well, I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 50...
Let me just stop here a second. I just want to point out, anyone who's listening to this is thinking to himself, okay, Warren Buffett, the great legend himself, says today, looking back, I would rather invest in what I do today than what I did then. So I just want to point out something. Two possibilities. One, is Warren Buffett speaking about himself, or is he giving advice to other people? If he's thinking about this question, what would I do today? And he's saying, I would do today what I do now and not what I did then. That doesn't mean he's still telling other people, I think your best advice is to do what I'm doing and not start off your investing career by doing cigar butts. That's possibility one. Possibility two is that Warren Buffett forgot, and maybe didn't think about it, that the reason he has such amazing success today is because all his knowledge that he learned out throughout the years. And maybe he forgot that someone who hasn't gone through what he has gotten through, it wouldn't be so successful in what he's doing today, like because he didn't gain all this experience and all this knowledge that Warren Buffett learned throughout the years. So I'm just pointing this out. And he's saying, I think I'll do this. So let's continue on with what he's saying.
6 to 69 was the best period. Actually, my best period. I mentioned that 50 huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year, and I think they were 37 points better than the Dow per year, something like that. But
okay, so let's stop here again. All the people who are so saying how cigar butt investing is bad and not close to growth stocks, I already showed you. Joel Greenblatt in 10 years doing kind of cigar butt investments of buying maybe not the classical cigar butt, but buying spinoff and all these not wanted kind of companies, made also 50% in his first 10 years. Warren Buffett saying his best time investing was before when he did the cigar butts, he was doing 50% a year in the span of 10 years. Give me a list of 10 great growth stock investors who have done 50% in 10 years. If we have a list of all these great investors, and we'll say, okay, then we have something to consider. Maybe it is better. And I'm not saying it's not better investment. That's not what I'm saying. I'm just saying it's not so easy as you think it is. And so far, investors like Monish Pabrai or Guy Spears or Nick Sleep, they haven't been compounding at the same rate as Warren Buffett or Peter Lynch Warren Buffett in his first version, Peter Lynch or Joel Greenblatt. So far, I haven't seen the evidence that starting off your investing career as a growth stock is better than starting off your career as a cigar butt investor.
that I was working with a tiny amount of money, and so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap. And obviously, as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it in that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically.
So let me just point this out again. You see how hesitant he is to say that he would rather do growth stocks than cigar butts. He's pointing, and again, he's saying, if someone like me and Charlie, with our background and all our knowledge we have, he's not saying everyone, and he's still saying you'll make a lot of money doing cigar butts. So I'm just pointing this out. Like, people are so saying, Buffett evolved and he became a much better investor and he started investing in growth stocks. I'm saying, one, the reality forced him to grow his circle of competence and go from cigar butts to growth stocks because he had so much money he couldn't continue investing in cigar butts. So reality pushed him to this point. And of course, he's a great investor and he knows how to evolve, and he evolved immensely. Other people weren't able to do what he did, and that's Warren Buffett's greatness. I think Monish Price says he knows how to take out all different kinds of knives at different kinds of fights. He's not just one kind of investor. And another point I want to point out what he says, he's saying that you'll earn a lot of money in doing cigar butts. So he's not saying as if like totally I'm like 100% sure that a growth stock is better than cigar butts. He's saying, he's like, you see how hesitant he is to say this. Not like in the other video I put in the beginning, like he said, I'll do this today.
But that's the nature of it. You've got to, when you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars.
So another point I wanted to point out is what I spoke before about the different kind of strategies there are in cigar butts. So over here you can see that Buffett's strategy was finding the good cigar butts. You see, he said he will go through 1,000 companies to find 2 companies. So you can see his same strategy of picking out good companies. So this is not like Bruce Greenwald's strategy, just buying everything at a cheap price, and you'll lose a lot on a lot of amounts of companies, but you'll earn a lot on the other ones that make great returns. So that's just another point about what we said before, the different kinds of strategies in cigar butt investments.
I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Charlie?
So let me just stop here again. When Buffett is speaking, I don't know if there were screeners, if there were screeners in those days or not. But going through a 20,000 page manual, yeah, that's very, very hard, and a lot of people can't do it. In today's day and age of screeners, we can do what Warren Buffett did the hard way in a much, much, much easier way. We still need the ability to analyze things correctly, but it's much easier to find today's cigar butts than it was in Warren Buffett's time.
Well, yeah, I think that's right. A brilliant man who can't get any money from other people and is working with a very small sum probably should work in very obscure stocks, searching out unusual, mispriced opportunities.
So here you can see again, Charlie Munger, he's the one who's famous for pushing Warren Buffett into being a growth stock company. He himself is saying over here, a person who's had small amounts of money I don't know if he's saying it's a better investment than using cigar butts, but he's definitely saying you can find amazing investments in cigar butts. So I'm just this whole video I was doing to point out the advantages and disadvantages, the pros and the cons. I read articles, and you can read articles online about people who are proponing growth stocks and saying how bad cigar butts are. There's some egregious articles that are so I almost call them liars. I mean, they're taking facts and totally wrong ways. I don't want to speak, but I'm saying I read egregious articles on people bashing cigar butts. So things change. So I want to get on to my conclusion of this entire video. Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much. Okay, so throughout the entire video, we explained all the pros and cons of all the different kind of investments. So I want to finish off this video with 2 points. The first one is don't get fixated. And what I mean by that is don't just get fixed on something saying this is the right strategy and this is not the right strategy. The greatness of Warren Buffett was that he was able to evolve. He was able to learning different things, growing his circle of competence. And the same thing is, if you want to go on cigar butts, don't get stuck on it. Try to evolve. If the same thing is the opposite. If you want to do only growth stocks, don't say, okay, I'm doing only this. And I'll applaud Monish Pabrai, although he's a very strong proponent of growth stocks. He himself says you can't do only Nick Sleep. You have to look for companies that are trading at low PEs, and I absolutely applaud him. I think he's very correct in that point. You can't only do one kind of investment strategy. The second point is adapt to changes. And what I mean by that is people are always saying that cigar butts was once a great kind of investment, but today not, because the market became more efficient. So exactly that's my point. Just like once cigar butts were efficient and today not, if things could change around the opposite of the same exact way. We can't know what the future is going to be in the stock market. We have no idea. Maybe there'll be another great recession, or I don't know what will happen in the world, and people will lose all interest in the stock market, and there wouldn't be so much efficiency, and there wouldn't be so many people investing in the stock market, and the growth stocks wouldn't be so amazingly good companies. If you would learn only how to do growth stocks, and you would never learn how to do cigar butts. So imagine for 10 years you're investing your entire career in learning how to do growth stocks, good companies, and then one day things change. Just like it changed from once when the market wasn't efficient and it became to a more efficient market, things could also go backwards. And now you have to learn how to do cigar butts, and you have no idea how to do it. So besides not to be fixated only on one kind of strategy, you have to adapt to changes. Just like Warren Buffett adapted from cigar butts to growth companies, you have to learn both of them. So I'm saying if you start off your career as a cigar butt investor and you're focusing on evolving, you'll probably have a much better career than someone who started off his investing career only in growth stocks. I'm not giving any recommendations what to do. This is my thoughts. I'm just bringing my perspective. I think young investors should not just totally say, I'm not doing any cigar butts. No, try to do cigar butts and growth stocks. Learn everything as much as you can and try to do both of them. And another thing I just want to add on, probably when there's a bear market, that's a time to look for growth stocks, because that's the real opportunity to buy great, amazing companies. But in a bull market, it'll probably be easier for you to find, also do cigar butts. It's another thing you can earn on the side. So I hope you enjoyed this video, and I'll be really happy to hear any comments, your thoughts. If you think I missed out something, if you have anything to add on, I'll be very, very grateful if you could tell me what's your thoughts on this whole issue. Thank you very much, and I hope you enjoyed this video.